Good morning. My name is Kathleen Kramer, and I'm proud to be your LaTip mortgage banker. And I also have been to cooking school in Tuscany, so I can cook some nice Italian food, and I do love to cook. And my husband is fond of saying that he's never had a bad meal in our house, so it's kind of a fun thing. And we like to adventure and travel, and we've been to some pretty cool places in Budapest, Hungary, and parts of Eastern Europe, where we've had an opportunity to eat some very interesting food. But it is always a joy. As I was thinking about what to talk about today, there have been a lot of changes in our industry in the past several years. Some good, where we have restricted the number of the fancy type of loan programs, interest-only programs, and we've instituted quite a few new rules. And so I wanted to just talk about a couple of them, and then I also wanted to bring to your attention some government action that's going on right now, with a hat tip to Jean Teagan, our qualified real estate agent, for putting out a notice on Facebook this morning about what's going on in Congress and what they're proposing to do. So just a couple of things. Several years ago, as a result of the market crash and the financial crisis, there was a piece of legislation called Dodd-Frank that was passed. And that created a new governing agency for lenders called the Consumer Finance Protection Bureau. They don't just govern lenders, but it's really all consumer credit. And the final part of those guideline changes went into effect on October 3rd. So anyone who is applying for a mortgage and buying a property or refinancing a property that isn't a commercial transaction, and residential transaction is under these new guidelines and rules. So I know that in LaTip, one of the things that we do is we try to help each other get business referrals and business to business. And one of the things that I brought to help you refer me is this flyer called TRID Timelines. And you don't really need to know a lot about TRID other than this is the final institution of the new guideline changes. And what I'll ask you to do is I'll ask you to think of your favorite realtor other than Jean, okay, your second favorite realtor, and share this with them. Take a photo of it, text it, email it to them, send it to them, and let them know that you're in a business networking group with a lender who's ready for these changes. So what we've done is we've put two different timelines on closings. And what you need to know about the regulation changes is it changed how the disclosures look, and it also changed the waiting times between when we present our clients with the disclosures and how long we have to wait before we can take the next step in the transaction. So in the beginning of the transaction, we have 3 days from the receipt of the purchase contract or the receipt of the formal loan application on a refinance in order to issue disclosures called the loan estimate. That really is not that different. We've always done a good faith estimate. The loan estimate is much easier to read. It's much clearer, and I brought samples for you. If you are really interested, you can come and see me after the meeting, and I'll be happy to show you what they look like. But the other requirement that changed was what happens before you go to sign loan documents. And the real meat and potatoes of this guideline change is that 3 days before you sign loan documents, we are required to issue you a closing disclosure. This closing disclosure has to have the final fees and charges, all the loan terms set forth in it, and it has to pretty much match the original estimate within certain tolerances. So if there are changes after I issue this closing disclosure, then I have to reissue the disclosure, I have to deliver it to you, and I have to wait 3 days after you receive it, not after I send it, after you receive it before you can sign your loan documents. This is to give you the opportunity to review the disclosure, to ask any questions that you might have before you go to closing. No more surprises when the notary shows up at your house and you look at the the closing statement. Now, I don't have that happen on my transactions, but I had the opportunity to sign some loan documents this week. And the notary said, you can't even believe how often I get to the table and the people look at the closing statement and they send me away. And I said, that is amazing to me because that doesn't happen to me. But I understand that it happens a lot. And this guideline change is designed specifically to prevent that very thing. And I think it's fantastic. The challenge is in the delivery, because if we rely on snail mail, the old-fashioned way, right, through the mail, we have to wait 7 days from the day we mail that to assume that you've received it, and then you get 3 more days on top of that. So it can be a very long period of time, and it can slow down a transaction. So at JMJ Financial, we have instituted some electronic delivery methods, and if the client accepts the electronic delivery of the disclosures, we can close a transaction in as little as 2 weeks. And that's what this flyer illustrates, is what would have to happen on a 2-week transaction. If you share this with your realtor, they'll look at that and go, wow, okay, we actually can close this deal, because most lenders right now are telling them to write the contracts for 45 days or more. But we can do that. The other type of loan that we do is what we call a takeover loan, and that's what's on the left-hand side. That's what I would also call a rescue loan. And what that is if there's been a transaction that's in escrow already and the lender can't get it done for whatever reason, and they come to us and they say, Kathleen, can you rescue this loan? And we'll say, yes, we can take over this loan. We'll get a package from the client, we'll look at it. If we can do the loan, we'll take it over. In those kinds of circumstances, it's possible to close a loan in 9 days. And this is important information for a realtor. So they may have their favorite lender, which is great, no problems there, but they need to know that JMJ Financial and Kathleen Kramer's team can take over a loan that's in trouble and get it done in 9 days. And that's a perfect world. Everybody's pulling together in the same direction, but it can happen. And finally today, I wanted to mention something that it could affect your pocketbook and the pocketbook of your kids who may be entering the homeownership realm soon. There is a proposal in the Transportation Committee in Congress right now. They're formulating legislation to add costs to home loans called G fees. The G fees are what we call guarantee fees that get added to Fannie Mae and FHA loans when they get funded, and they're a percentage of the loan amount. These loans are the very kinds of loans that are designed for first-time home buyers. Most first-time home buyers use either an FHA loan, a VA loan, or a Fannie Mae, Freddie Mac type loan, and these are the loans that are affected. We've had G fees in effect for a few years to help shore up these agencies after the financial crisis, and now those agencies are back on their feet. Well, the government, our government, in its infinite wisdom, now wants to take those funds and transfer them into rebuilding our roads and our infrastructure. Now, this is not necessarily a bad idea to improve our infrastructure, but I don't think we need to do it on the backs of our first-time home buyers, our students who are coming out of college with loans, who are having a hard enough time getting into the real estate market. This is exactly the kind of person who's in the middle class, because jumbo loans over 625.5 are not affected. Jumbo loan lenders are privately secured and there are no G fees. So the government is particularly targeting middle class and our first-time home buyers to help rebuild our infrastructure. What can you do about it? You can contact your federal congressman and House of Representatives representative and tell them to cut it out.
I could post it again on Facebook.
Jean posted on Facebook this morning a link to the National Association of Realtors where you can sign along on the National Association of Realtors letter that they have written to our Congress to tell them to stop this mess. It's nonsense, and we really need to look out for our younger generation because they're coming up after us and they need all the help they can get. So if you're looking to refer an excellent lender and you want someone who will take care of your clients, who will give them an honest, ethical loan and make sure that it's something that they can afford and that they can sustain, then please think of me and JMJ Financial. Any questions? No. Thank you so much. Oh, one.
So these are products that you're offering, or a service?
No, this is the service. So the way to communicate this to a realtor is say, you know, I have a lender in my networking group. I know you already have a lender that you work with most likely, but if you run into trouble, this company has the new regulations under control, and they can help rescue a deal if it's in trouble in 9 days.
Okay. And because I know realtors out of state, is that possible, helpful, or?
Thank you. It's a very good question. JMJ Financial and my license is good for California. So I prefer to keep my transactions with all the regulatory complexities. It's hard enough to do loans in California, and we like to maintain that level of service. So I appreciate the question.
Sure.
Thank you very much.